Welcome, everyone. Let's start today's webinar. Thanks for joining today's webinar on the SEC climate rule and materiality, great in principle and harder to apply in practice. My name is Seth Foreman. I'm the CEO at Socialsuite, and we're really excited about today. I do want to introduce a little bit about Socialsuite for those not familiar with us. Socialsuite is a global sustainability and impact technology company specializing in materiality software solutions. And so as we jump in today, I do want to go through a few housekeeping items about today's webinar. Firstly, the content of today's webinar will last about 30 minutes, and then we're going to hold the Q&A session. If you look on the right-hand side of the screen, there is a chat area. So during the conversation, if you do have any questions or comments, please feel free to add them into the chat. And our experts during the day may answer those questions during the conversation, or we'll answer them during the Q&A session towards the end. The other update is that we will share today's recording to everybody that's joining today's webinar. So please expect to receive the recording generally within 24 to 48 hours after the webinar. So let's jump in and meet our experts today. I'll ask each of you to please introduce yourself. Let's start with Michael. Please introduce yourself.
Everyone, I'm Michael Arnold. I'm a partner at the firm of Cravath LLP More in New York. I'm in the corporate governance and board advisory practice. I do a lot of work on public company reporting and ESG, and now we have the SEC kind of combining those two into one. So great to be here and looking forward to the discussion.
Perfect. And over to you, Tim.
Excellent. Thanks, Seth, and welcome, Michael. Tim Siegenbeek from Heukelom. I'm the Chief Impact Officer at Socialsuite. I really look after the domain expertise at Socialsuite, what is happening in the sustainability and ESG landscape globally, what's relevant, and how can we make sure that any of our customers are really kind of at the forefront of ESG sustainability reporting, and in particular, how does that materiality piece of work unfold globally. There's different ways of doing it and really helping people to make sense of it and make most of it.
Perfect. Well, I'm going to come off the stage. I'll leave the conversation to the two of you to take it from here, and I'll be back for the Q&A session. So take it away, Tim.
Excellent. Thanks, Seth. Wonderful. So today we have three kind of main items on the agenda. What we're going to do in the webinar today is we're going to look at the requirements of that SEC climate rule. Now, there's a lot of information already out there. You might have already seen summaries. Because the rule in itself is close to 900 pages. It's a very extensive, very long one. And I know Michael's read it. Oh, he's got it there.
Yeah.
There we go. So I'm very, very happy that Michael's done the hard work. He's gone through that whole rule. He's made copious notes. He knows in and out. So I'm glad to have the legal expertise here today. So there's a lot in that rule. So this webinar is really going to touch upon the key requirements. And I think with that, it's really important to keep in mind that we're going to run you through some of those high-level requirements and components there. But if you really want to get down to that level and really want to make sure that you do everything correctly, then make sure that you look at the rule or get someone like Michael to help you, work your way through that. So it's really important to put that caveat out there. But we'll run you through the high level, what's required. But mostly, we're really interested in that materiality piece. So what we've seen is that materiality is a large and important dependency for a lot of components in this rule. So we're going to take you through that. How does it actually work? And how is that maybe different from what you're expecting around that in relation to climate and sustainability? So we're going to run you through that. And then after that, so what are some of the actions you can take today? So we're going to end today with looking at three pathways of scenarios where you as a business could be in your climate journey. And then look at what are some of the next steps you can take to make sure that you're well prepared, ready to disclose against the SEC climate rule if you have to. We'll end with a Q&A as set flagged. So make sure to use that chat box, put some questions in there. We're going to collect them. And at the end of the webinar, we'll come back. We'll try to answer all or most of them if time allows. So with that, what are the most important requirements? So what are those key components? what we've done is we put a few here together that we're going to run through today. So this is a little bit of that overview today. I'm going to talk to you about reporting. So who needs to report and when do you need to report? So that's in the phased-in approach. And we'll ask Michael about assurance and attestation, like what do you need to do, or do you need to do anything in that space? Then we'll look a little bit more about how's the rule actually built, what's the backbone of the rule. And in this case, we're going to talk about the task force on climate-related financial disclosures, which is really that framework that the rules build upon, which is great. And we'll talk about why that's so important. Then we'll look at two key components that are key components of TCFD and hence of the climate rule, GHG emissions and climate-related risks. And then we'll look at that materiality piece, and we'll really kind of, like I said, go a bit deeper on that and spend a bit more time. And now you've seen I've skipped one box here because I think that is good to straight away address there. You might have seen in the news already that there are a lot of people saying, well, there's a lot of opinions and views about the rule. Like it's gone too far, it hasn't gone too far. So, there's a lot of people that are not happy for some reason. And there's a lot of suits already being filed because, for various reasons. What is the impact of that? Or do we know what we can expect? So Michael, what are your views on that? Is it going to delay implementation? What do you think? Is it just a distraction?
I think it's a bit more of a distraction. Look, I think there's a lot of very interesting questions that are being raised by the litigation. I think it's important for practitioners in this space to keep an eye on it. But what you should definitely not be doing is expecting that the litigation is going to be a, deus ex machina that is going to save you from having to be ready to comply with the rules. The fact of the matter is the litigation is very uncertain. There are arguments each way. I think the SEC, needless to say, took a big change from what the rules were proposed. That step makes it much more likely that these rules will survive litigation. It's not certain. But I think there's a lot of kind of speculation and attention being paid to, will the rules be stayed during the course, the pendency of the litigation? The fact of the matter is, even if they are, I don't think companies are really in a position to sort of go pencils down and rely on that. If the stay is lifted, it won't really affect the compliance periods. Those will pretty much snap back into effect if the SEC, wins at the lower court level. So while it's interesting and you should, I guess, keep one eye on the litigation environment, same with the presidential election, you should pay attention to that because that could conceivably affect these rules long term. It doesn't mean you can avoid being ready to comply with them. It's just too uncertain.
I like that. So get ready to comply. We don't know where it's going right now. It's on the books. So great to get that straight away off the bat, sorted. So don't sit back and wait for everything, the dust to settle. There's a rule there. Let's look at it in a bit more detail, what it actually means. So I think the big first question for a lot of people is like, will it affect me? Yes or no? And if it does, when can I expect that to happen? So what's your take on who needs to report and who's excluded?
The short answer is everyone who's a public company is in the U.S. is covered. One of the things that was very closely watched was how will the SEC treat so-called FPIs, foreign private issuers. So companies that are not U.S. registered companies, but that trade in the U.S. or have registered stock here. The answer is they are subject to the rule basically exactly the same as U.S. public companies. There is not sort of a substituted compliance regime for ISSB or CSRD, even if you're subject to those regimes. So if you're an international but trade in the US and are a public company, a public reporting company in the US, you are subject to these rules. There are some accommodations for smaller companies, but mostly those are on the form of the timeline for compliance. There are a few things that the smaller companies, smaller public companies are not subject to. So, for example, some of the attestation requirements are scaled that only apply to the large accelerated filers or accelerated filers. But for the most part, it's a very broad sweeping rule. I'll also underscore the IPO issuer's point. You may not be a public company today, and as a non-public company, you may be subject to things like the California rules or CSRD or something like that. But if you are planning on going public, these rules will apply in IPO registration statements for the most part. Now there are some limitations on that, some of the GHG emissions disclosures, et cetera. But for the most part, if you should be ready to kind of build the appropriate the appropriate kind of control regime, et cetera. So if you do IPO, you'll be ready.
Great. So a lot of people may wonder, whether they're in FBI and already have to do other work, mandated work elsewhere in the world, or they're already doing voluntary reporting on a lot of climate there. What it means in short is that you still need to follow the SEC disclosure rules. You might already be disclosing all kind of climate related information, but follow the rule, do what you have to do. So where do you need to report that from an SEC's point of view?
In your regular way filings. I mean, one of the points of debate in the proposal and in the comments was, should there be sort of a separate report? I mean, you could imagine that the SEC requires a separate form that gets filed on a different timeline. That's not where things really landed. It's really built straight into your 10K or your 20F if you're an FBI. So it's your standard regular way reporting. The one exception is for the quantified GHG emissions, which we'll get to a little bit. There is a delay permitted there where essentially you can incorporate by reference to the following fiscal year's second quarter filing. So that is the one accommodation, but generally this will live in your SEC reporting. And what that means is it's subject to all the same sort of SOX control procedures, all the same assumptions about rigor, the same litigation risk. It'll be right there in your regular SEC reporting.
So in principle, pretty simple. All in the same document, no new forms, straightforward.
In principle.
In principle. Great. Then let's talk a little bit about that reporting timeline. Now, there's a number of different registration types. There's different timelines, there's different components there. So what I've seen online is a lot of people trying to visualize that in some way. And I found this one done by Boston Consulting Group, Timo, and pretty good. There's different ways of looking at it, but what stands out to you looking at those timelines here? Is there anything in particular that surprised you or that you feel that people really need to be aware of?
So I'll say two things. One, I think it presents a nice sort of illustration of a couple different phenomena here. The first is how staggered they are within each of these different groups. So, there's a little bit of a delay between some of the more quantified Reg SK, so, non-financial statement, but Reg SK disclosures. You get an extra year on those. I'm also kind of struck by how far out some of the timeline goes. When you look at the reasonable assurance attestation requirements, you're all the way to, fiscal year 2033 filed in 2034. So everyone mark your calendars for that. Be sure to be paying attention to that in a decade from now. The other thing I would say, though, is this doesn't tell the whole story because it looks like a lot of things are in the future. There's some really important stuff that needs to be happening in short order. So one that I'll call out is that the Reg SX disclosures, now these are the disclosures that go in your financial statement, the sort of climate-related footnote, where you need to quantify expenditures and capitalize costs related to severe weather events and other natural conditions. Those kick in the first wave for large accelerated filers, such that, you will be reporting fiscal year 2025 data in your 10K for 2026. If you kind of play that through, that means that you need to have controls and procedures and accounting policies to really calculate this information and assess these different incidents starting from January 1st, 2025. That's why it's an important rule to kind of take seriously and take action now, even if it feels like a lot of these disclosures are way out there on the timeline.
Well, thanks for that insight, because if you look at it at first glance, it looks like a very generous runway. The moment you see, 2030 plus, you're like, oh, we got plenty of time. But to your point, it's really important to realize that a lot of these things take time to develop, to put systems, to put resources in place, to skill up people, especially if you haven't done much in this space yet, there's a lot of work to be done to get ready to make the disclosure. So I think it's the most important message about the timeline is, yes, it's phased. Yes, there's some things that look like they're pretty generous in terms of getting there, but in reality, you'll have to start, relatively soon to get your house in order.
Absolutely.
Now, going into the assurance and attestation, we've seen there's a lot of questions around that, like what exactly is expected. What do you need to do around that? What is the high-level overview from your perspective there?
So this is one of the parts of the rules that only apply to the largest public companies, so large accelerated filers and accelerated filers, with a little bit of a difference between the two. So large accelerated filers will need to get at least limited assurance beginning in their 10K in 2030, covering fiscal 2029. There's a little bit of a further delay for accelerated filers, so that's for the 2030, the 10K filed in 2032. Limited assurance is a lower standard than reasonable assurance, and reasonable assurance attestations are essentially at the same level of certainty as you get from a regular way audit, just your regular financial audit that your auditor is doing now. That will kick in. This is the furthest timeline. You know, the key thing for companies to know at this point is I think there's going to be a lot of changes in the market for attestation services between now and when these rules kick in. There are some pretty detailed requirements in the final rules about who counts as an expert for these purposes. You know, how the attestation process needs to unfold. It needs to be done pursuant. There's not sort of one specific standard that the SEC requires. Rather, there's sort of a principles-based way of identifying different potential standards that could be required. So it seems like anything done pursuant to PCAOB standards or iOS standards are going to be okay. But I do anticipate that over the next few years, there will be a bit of a flux in figuring out how these attestation engagements really work. The other thing that I would note is, you know, you may be paying one price for your attestation services now, but keep in mind that every public company that's a large accelerated filer or an accelerated filer will be out there in the market trying to get their own attestation services. I do think that the rules will prompt some expansion in the industry and give you more attestation service providers to pick from. But I do think there's going to be a bit of a rush to try to engage, and it wouldn't surprise me if the cost of these go up over time, particularly as attestation providers potentially, you know, take on their own liability for having their attestation reports included in 10Ks as well. So something to monitor over the next couple of years.
So a question we've seen a lot already, companies that have done their scope 1 and scope 2 GHG emissions footprint, they got a third-party independent business to do that. And they're like, well, they were independent, so everything is, you know, fine, right? They've done the work, they checked it, so we don't need to get any other checks or balances in place there. What would be your answer to that?
Well, a couple things. First, there are requirements in the final rules that if you have voluntary attestation, even before it is required, there are also some requirements to make disclosures in the 10K about that voluntary assurance. So you're not, you know, it's obviously good to, you know, have disclosure ready data and have it gone through a rigorous process with your attestation provider, but just keep in mind there will be some early triggers even before the requirements that are illustrated there on the slide. So that's one response. The second response is, you know, attestation will help you identify certain issues, but it's your own liability, right? I mean, this is, you know, it is incumbent on companies to really think of GHG and climate related data with the same rigor as they think of their financial statements. And yes, in your financial statements, you certainly hope that your auditor is going to find any issues or correct any errors, but ultimately that is your financial statements that are going out there. And I think the same mentality has to be adopted for GHG matters as well. I mean, these are your emissions reports. They should be subject to your control environment. The same sort of, you know, rigor that you would apply to, you know, calculating revenue and expenses should go into calculating your GHG emissions.
Good point. So yeah, generally what we would say is anyone doing your carbon accounting for you, check with them, like how rigorous is the process? What are they doing in terms of, you know, whoever pulls it together for you, how are they checking that? Is there an external party that they use to check their work again? So it's really important to look at whatever you're already doing or starting to engage with, how rigorous is that?
100%.
Now, that was some of the mechanics of what we can expect. Now, I think it's really important to look at, this is all not brand new in a way. The SEC took a while to, you know, they proposed the rule. To your point, they made quite a few changes there after a, you know, comment period there. But I think the main thing that hasn't really changed is that the mechanics of how it works is really based on the task force of climate-related financial disclosures. So an existing system of recommendations, how you can report on climate-related financial disclosures, looking at 4 components there: governance, strategy, risk management, metrics, and targets. So it's really interesting to look at that rule and see that they've really taken this on. And that's not unique. There's a lot of jurisdictions that have done that. There's a lot of voluntary reporting as well, that all's going back to that TCFD framework. So if you've done anything already in the TCFD space, and you might have been exploring that, you might already be actually reporting on TCFD, you're doing a lot of the work already. Now, of course, you're not done there yet, but I think that it's really important to see that these things kind of don't come out of nowhere. There's really a lot of thought gone into this. TCFD has been very widely accepted globally as a really climate-related financial disclosure framework. A lot of companies globally are reporting using that framework. So it's a good, strong backbone, a strong framework. Now, if you are a company already doing this, you got your TCFD reports. Now, what do you need to do from an SEC climate rule perspective? If you're already doing that TCFD work, what are the key next things to keep in mind?
Yeah, you're absolutely right that if you are being rigorous in your TCFD reporting, you should probably have a leg up in being ready for the SEC rules. Now, one thing I will say is that the TCFD framework, at least in kind of private practice, there's a little bit of optionality, right? Well, we're really interested in these parts of the pillars. Maybe we don't follow this recommendation perfectly, but it's really not that important to us. The SEC doesn't really work that way, right? There's no sort of, thanks, but no thanks. We're not going to comply with this one. If, while a lot of the rules are materiality qualified, and obviously we'll be spending some time talking about materiality, be sure that just because you've done a TCFD report, make sure that you're covering all the items in the SEC rule. So that's the gap assessment versus your TCFD reporting. Make sure that you're really covering the SEC requirements. And also then, compare and contrast against other regimes you may be preparing for, CSRD, for example. There are also, of course, things in the SEC rules that are not part of the TCFD reporting. And so there I would go back to the Reg SX, the financial statement footnote component of the rules. What was proposed on the Reg SX footnote was, in my view at least, totally unworkable. I mean, the proposed rule was frankly way too aggressive, and I don't think was really operational. It was going to be very challenging for companies to comply with. The proposed rule on the Reg SX front is not exactly easy, but it's at least feasible. So what you need to be doing there is, these require, assessing from kind of the first dollar and the first event, the effects of severe weather events and other natural conditions. What should be happening, I think, for a lot of companies now is working with their accountants to be prepared to assess what is a severe weather event, what do we consider as a natural condition. If you watch the open meeting when the SEC adopted these rules, that was like one point of questioning from one of the commissioners who ultimately dissented from the rules. And the SEC's advice on that front from the chief accountant was write your own policies to figure out what you consider as a natural condition. So I think there will be some real work on the accounting side to kind of roll up your sleeves and say, all right, we consider this another natural condition. This is how we go through our P&L and say these expenses count and these don't. That'll be a process that should probably get started, and you will not be necessarily prepared for that if you're a TCFD reporter.
Great. So really good advice there. TCFD does give you that leg up, but really look at the fine print of the rule, because there's more work to be done there. GHG emissions. So one of the key components that sits within TCFD. A lot of companies are aware of carbon accounting, not a term to put it. Now, where we landed is that again, based on materiality, there's a reporting of scope 1 and scope 2 emissions. In the proposed rule, scope 3 was included, but that is no longer part of the reporting requirement. So that's a key change there. What are some of the highlights here around GHG emissions that stand out to you?
Yeah, I think obviously the headline is, as you say, that scope 3 didn't make it into the final rule. I mean, we talked a little bit earlier about the litigation environment. I think that plays a key role in understanding why scope 3 was not in the final rule. One of the sort of begrudging yes votes on the rule was from the Commissioner Caroline Crenshaw, and I think she regretted, frankly, that scope 3 didn't make it into the final rule. Keep in mind, that it could come back in a future SEC that scope 3 will be required, but there was no sort of requirement to disclose scope 3 emissions, based on materiality like there was in the proposed rule. Now, I think people have maybe overemphasized that a little bit too much, though. It got a lot of headlines, scope 3 is out. keep in mind, there are some important areas where scope 3 related disclosures are in the rule, and you should be paying attention to those principles. So I'll underscore here the targets and goals disclosure requirements. So the SEC, similar to what was in the proposal, has a requirement that if you have a target or goal that's climate related, and it basically materially affects your business, you need to be providing year-over-year updates to your investors in your 10K as part of this climate disclosure. There's no exception in that sort of requirement if the goal is denominated in scope 3. So if you have adopted a scope 3 GHG reduction target, and that is materially affecting your business, and parenthetically, I'll also add, it doesn't even have to be a publicly announced GHG reduction target. If you have, something that has already been adopted interior to the company but hasn't been disclosed, that would be within the scope of the disclosure requirements, and so you would be reporting your progress towards that scope 3 target or goal. What that means, I think, then is, similar to what I mentioned earlier about the importance of rigorous data and controls. Your scope 3 GHG emissions would then be subject to the to disclosure controls and procedures pursuant to the Sarbanes-Oxley Act, just like your scope 1 and scope 2 emissions, which are required if they're material. Another question I've been getting a lot in the last couple of weeks is, okay, well, and we'll talk about this a little bit also, I've already decided, it's immaterial. Scope 1 and scope 2 are immaterial to me. I'm never going to track scope 1 and scope 2 emissions, right? Not really. If you look at the SEC adopting release, they sort of indicate very strongly that even if you are not going to report your scope 1 and scope 2 GHG emissions because they're not material, you still really need to be calculating them in order to make that determination. So I think there's going to be it's very important for companies to know their scope 1 and scope 2 GHG emissions so they can do the materiality assessment that we'll talk a little bit more about in the next few minutes.
I think that's two really good points there on that, understand your scope 1 and 2 first to be able to do that materiality determination. That will pick up that one. And the other one on scope 3, and I think that's a good jump to the next component as well. Scope 3 is effectively your value chain. So think about your upstream, your downstream. So yes, scope 3 GHG emissions might not be required to be disclosed, but you might still, need to, be aware of them. But if we look at this next component here, climate-related risks. So that is really a key component of TCFD as well, is trying to really understand what are those climate-related financial risks that the business faces. But in this area, you do need to look at those risks across the entire value chain. So whereas for scope 1 and 2 emissions, that is really clearly defined, but with these risks here, that is across your whole value chain. So that's really important. I've seen some advice out there, you don't need to report on your value chain. That's incorrect. Like climate-related risks do go across your entire value chain. So that's a really important area here. I think this is a pretty straightforward component here. So I've kind of leave that there. There's a lot in TCFD that gives you a lot of good insight around climate-related risk and what can be done and how you need to go through that. What I want to do is pick up your point on materiality and kind of jump into that. That is really important. How does that materiality determination work there? So what we've seen is that a lot of components in the SEC climate rule are depending on that, let's quotation mark, a traditional financial materiality determination. And I'm saying that because with the kind of emergence of sustainability reporting, we've seen some, slightly different sustainability related materiality in definitions also. So yeah, the concept of double materiality, where we look at, yes, that financially accounting kind of clear financial materiality concept, but we also look at something else, which is impact materiality. And that is different because it's not saying what are the impacts on the business, it's saying how is the business impacting the world. Now, if you do global reporting initiative, GRI reporting, their materiality assessment is impact materiality. How is your business affecting the world? So if you're doing all that work and in that you find that climate and GHG are not material, you're like, well, right, we don't have to do that. That's a different way of looking at materiality. So for the sake of the SEC rule, what are we looking at from a materiality point of view? What's the definition we're using?
Yeah, the SEC was very clear, and I think there's a litigation overlay to this as well, we're using just traditional US Supreme Court definition of materiality, a substantial likelihood that a reasonable investor, blah, blah, blah. I won't read what's on the slide for you, but this is the same materiality determination that companies have been making under SEC reporting for years and years and years. It's the standard sort of formulation of materiality, not impact materiality, but financial immateriality, the effect on the registrant. Now, that doesn't mean that you're entirely out of the woods. And I think the title of this webinar is instructive, right? Because it can be very tricky to apply that in practice. And there are a few different ways that your materiality assessment can be, second guess post facto. At the sort of highest level, there's SEC enforcement actions. I mean, those rest on the SEC disagreeing with a company's conclusion often that something is material or immaterial. There are comment letters, even under the sort of prior regime of SEC rules before these climate rules were adopted. The SEC was very active in putting out comment letters on climate-related matters and really sort of pressure testing companies to show their work on their materiality determinations, and going 2, 3, even 4 rounds of comment letters, really pushing on, is this really not material? Until effectively, I think most companies sort of gave in and concluded, okay, fine, we will put some information in there. Shareholder lawsuits, those often rest on whether something is material or not, or whether there was a material omission or not. Right now in the US, as a very litigious society, it's actually remarkable how, relatively speaking, little those sorts of suits have taken off. But if there is sort of the prospect of those becoming more profitable, I do think the plaintiff bar will be particularly interested in really drawing a line on, materiality determinations in the reporting and bringing suits based on that. Even separate from sort of the traditional plaintiff bar, I think you could also see, activist-oriented investors bringing suits, kind of similar to some of the suits that are brought in Europe, in the Netherlands, et cetera. And just shareholder engagement. I mean, you can make a materiality determination, determine something's not material, and thus you're not going to report on it. But if one of your big investors is sitting across from you in an engagement meeting and explaining, actually, no, we do think this is interesting and we want to know about it, it's a bit of a pressure test to your materiality determination. So it's traditional materiality, but as we have found with other definitions, other uses of that traditional notion, it can be asked about post facto.
So there's a lot happening around that materiality determination. There's a lot of components that are expressly tied to materiality. So you really need to work your way through some of those components, do that materiality determination to make sure you fully understand that. You already raised, I think throughout the webinar, we raised a few questions here, but we've seen that there's a lot of questions coming, I think your way, my way, around that materiality, application to the SEC climate rule. Now, the first one really touched upon it, kind of, you've done your broad-based materiality assessment. Out of that climate GHG, they were not found to be material. Do I now, do I have to report on the SEC climate rule? Well, we need to look at what are all the components of the rule. That's one, but also go back then. How have you done that materiality assessment? So what really did you do there? Was it a GRI impact materiality assessment? You probably have to do that financial materiality assessment again, or have you really look at the process and really make sure that you go over it again. What are your thoughts on that if people ask that question?
Yeah, 100%. As you say, not everything is materiality qualified. You still need to give a lot of your governance disclosures, for example, even if you don't consider them material. I would also say that, if you have done a materiality assessment, there are some things in the SEC rules which essentially instruct you to consider certain options, certain items, and certain factors in assessing the materiality. I'm guessing those you probably didn't do that materiality assessment before that rule, and if you're ever asked about your materiality assessment post facto by the SEC, you'll want to be able to point to the fact that you considered what they told you to consider. So be sure to kind of refresh it from time to time. I mean, materiality is not static.
I think that's a really good point. It's something we always emphasize with doing a materiality assessment is be really clear about what you're doing. Document every step, every consideration, methodology, rationale, approach, so that later when people ask that question, how did you get to that determination? Yeah, whether it's right or wrong, but at least here's the process, how we got there. And I think that's a key component we see both, from a more traditional kind of perspective around materiality, but also anything sustainability relating, document what you're doing. That will help you a lot if you can explain the process, how you got there.
100%.
Then I think we touched upon this one as well, but really quickly. So someone's like, my business is very low GHG scope 1 and 2 emissions, so it's not material, right? You can move on now. What does that mean?
I think it's indicative. I wouldn't say it means that you're totally out of the woods yet. One thing is you want to be able to document your considerations. So that means there's a process, even if you think you probably know what the answer is going to be at the end. You know, the SEC also says you should be considering if there's foreign or state law kind of regulatory burdens that are related to climate emissions, and whether it's, you know, necessary for an investor to understand your progress towards a goal. That should be a factor that weighs in your materiality assessment. So you may have a very low GHG emissions, but if you have a goal and you need to report your progress, that may lead you to think it is material. The other kind of macro point I'd mention here is that if you are going to be disclosing your GHG emissions pursuant to California or pursuant to CSRD, there may be a bit of a thumb on the scale on the factual reality is, look, we're already doing this reporting. It's out there in the world. Why bother taking the risk of being, you know, second guessed about the consideration of materiality? You know, maybe we lean towards doing it, but I still think you want to have a rigorous process.
But that leads into question 3, which is a really good bridge to that, is my business is already doing GHG accounting, voluntary TCFD reporting. We've been doing that for a long time. I think in doing that, my investors now kind of expect this information. So the expectation, since I've been doing this, does that expectation in and of itself make it kind of material in that sense? Like you said, you know, maybe if you do a pure de facto, you know, materiality assessment, you find that, well, by doing this, it's not material, but I've been doing this for some years. My investor sitting is across from me saying, well, you might think it's not material, but I think it is. Where does that land?
I guess you need to assess whether they're a reasonable investor or not. No, I think it is a relevant factor to consider. And, you know, frankly, I think this also sort of speaks to some of the other questions too, like number 4, right? Like I may have very high GHG emissions. Does it make it automatically material? I don't think anything makes it automatically material, right? I mean, this is a facts and circumstances, you know, based inquiry. And, you know, how you assess materiality may differ depending on which item you're talking about. I mean, if you look at question 6, who at my company needs to decide what's material? Sometimes it'll be legal people. You know, there's some materiality elements of the SX portion that'll likely involve your accounting team. You know, you talked about the material supply chain disclosures. That could be someone from your supply chain function could be involved. I think you need to be very flexible in really following the command of materiality to assess all facts and circumstances. You need to do it in a flexible manner.
Yeah, and I think that goes to point 5 as well, where we're looking at that climate-related financial risk component, and we've seen companies, it's my board and management have looked at, you know, our risk. We have a risk process. There's nothing there. You know, there's nothing to disclose. There's nothing material. But the question often there is like, have you actually gone through a full value chain, focused on climate? You know, risk assessment. Have you actually done the work? Are you relying on more traditional, you know, risk management? You haven't actually asked the question there. So I think all these things go back to don't assume, do the work, go through it, check and double check, document what you're doing, and really look at what does the SEC rule really require. So I think that, you know, a lot of these questions kind of have a pretty similar answer there. So that takes us then to the final kind of thing component there, which we'll look at. So what can you do now? And, you know, you might be sitting there thinking like, oh, this is a lot. I'm just starting now. And we were saying that the fact that you show up in this webinar means that you're already started, like you're here today. So that's good. The people that are not here today and haven't done anything, they might need to worry. The fact that you're educating yourself and they're getting ready. So if you're starting today, clearly there's a lot of work to do. So don't wait for that timeline to kick in a few years. Start today. And we've outlined some of the steps here, and it really kind of follows the content of this webinar. Think about, do you have to report and when? Think about, you know, compliance plan. Think about that materiality determination, but also really think about how you do that. So what's the process? Who's involved? What information do you need to do that? Same goes for that climate-related risk assessment there. Really think that through. And then in your business engaged cross-functionally. So get all the key people in there. So get your account, your controllers, but also get, larger people that understand procurement and, that understand your supply chain. So really get a cross-functional task force or committee around this together to make sure you're not missing key components. You might already have done some work. You've done your, scope 1 and 2 GHG emission footprint. Again, go back to that. If you've done it on a voluntary basis or for other jurisdictional requirements, look at what you've done, check that. Also look at any existing governance processes that you have in place to really kind of start looking at what you've already done. Pick up some of the other components out of the just starting bucket there. And if you're already on that, full TSC or TCFD reporting, we flagged that earlier in the webinar, there's still a gap assessment. There's still some things you need to do. TCFD does not cover everything. It's a great starting point. So if you feel like, we've been doing some TCFD work, we're done. No, you're not done, but you've done a lot of the good work already there. Michael, any final thoughts before I ask Seth to jump back with some of the questions there? Where would you leave this for most people?
I think you nailed it, and I want to make sure we have some time for questions. So I'll let Seth back.
Excellent. Well, Seth, while Seth's jumping back in, always talk to us if you have any questions. We're always happy. We'll try to answer as many questions as possible, but we're definitely always there to have further conversations. Over to you, Seth.
Perfect. And I'm actually right now putting into the chat a link. And if anybody on the call has any additional questions or thoughts or just wants to speak to Socialsuite about any of the content today, feel free to just book an appointment on the schedule there. But let's move into Q&A here. So one of the questions that came directly to me that's not on the chat box, but I thought it was a good way to get started. So someone asked, since the SEC rule is being actively litigated at the moment, does it make sense for our company to get started now? Or should we wait until this final outcome in terms of what actually the end result of what comes out of the ruling?
I think you should get started now. And look, if the courts take it, strike this down, or there's, Trump gets reelected, there's a lot of ways things could change. What's not changing is investor expectations and other jurisdictions like California, Europe, et cetera. So frankly, I mean, who really knows? It's a coin flip, let's say. And then the requirements will kick in, and you'll be way behind the 8 ball if you haven't started. So it's important to start working now.
Okay, great. Thanks, Michael, on that. All right, so I'm looking at the chat here. I'm going to go through these questions one at a time, and we'll answer them as best as possible. So Lisa asked, when will XBRL tagging be required for the climate disclosures? What taxonomy will be used? And over to you, Michael, if you know the answer to that.
I will concede I control F my way through the release to find the answer. So XBRL will be required for these. So for the reports that the 10K filed in 2027 covering 2026 for the largest issuers, and then one further year for smaller reporting companies, EGCs, and non-accelerated filers. But it'll be XBRL tagged.
Okay, thank you. Okay, Rachel asked, do you think there will be pressure to early adopt given many companies have already done a lot of work and the S to X requirements are required earlier?
It's a good question. I think probably not, in part because I think companies will want to take as much time as they possibly can to be ready, to be, very rigorous about how they sort of are reporting these issues and building their controls processes. We saw after the SEC comment letter wave about climate matters, some degree of slight increase in the amount of climate related information that was making its way into the 10Ks. Maybe that continues a little bit, but certainly people won't early adopt the SX disclosures, and it will probably be around the edges rather than wholesale.
And then the subsequent question on that is, have you heard anything about SOC 1 type certification as it relates to GHG service providers?
That I will concede I don't know the answer to. So I don't know. I do think that, I believe there's some discussion in the adopting release about about some of the different providers that have been sort of authorized. I don't know the answer on certification. I mean, it's certainly not going to be like, you know, for example, the auditors that are regulated by the PCAOB. We're not going to get to that level, I don't think.
Yeah, and there have been a number of questions as it relates to, you know, SOC 1 auditing and then just general assurance that we've semi-covered as part of this conversation. But I do think in the future, Socialsuite will run a webinar related to assurance. That's quite a topic where we could specifically have a dedicated webinar around.
And I'll join and learn something too.
Of course. Okay, Aparna asked, do you have an idea of how soon Scope 3 emissions might be looped into reporting requirements? Are there conversations happening around this? So to the extent that you're aware, Michael.
Look, there certainly are people who think the rule didn't go far enough. I mean, there was a lot of pressure applied throughout the process to change the rule in various ways. I mean, you look at people who are pointing out some of the problems with the proposed rule. There were some people who thought even the proposed rule didn't go far enough. So it's not immediate. It will not be a near-term priority. I mean, the SEC has a very busy agenda, and frankly, I think they're sort of, you know, very happy to get this off their plate and done. I mean, it was a lot of work on the SEC side. But if you think about kind of, you know, future Democratic administrations and future SECs, it wouldn't surprise me if this came back after they tackled things like, you know, human capital management, you know, board diversity, those sorts of areas.
Great. Well, appreciate answering those questions. I think that concludes our Q&A session. So just as we get into wrap up here, so if Tim could go to the next slide. So again, I just want to communicate to the audience that we will be sharing a recording of this webinar in the next 24 to 48 hours. On behalf of Socialsuite, we do want to thank Michael for joining us today. That was excellent, incredibly informative. So thank you so much. And for everybody in the audience, as mentioned, if you have any questions about the SEC webinar, about materiality, or anything as it relates to sustainability, please feel free to contact us. You could book a meeting directly with our team right in the Calendly link in the chat, or you have both Tim and my contact information is here on the left. So on behalf of Socialsuite, thanks again for your time for joining us today. And please look out for future emails as we continue to run our different webinars generally on a monthly basis.
Thanks for having me.
Thank you.